Hey everybody, welcome back to the weekly market analysis for the week ending December 1st, 2023. Happy December. We are in the last month of the year, the last month of the last quarter of the year, and we've got a lot to go over. The markets have been grinding higher today, ending on a really high note, and we'll see if that momentum is bound to continue, and we'll take a look at what the probabilities are of prices continuing to the upside or prices pulling back across different asset classes. But before we get into that, I want to remind you to hit the like button and subscribe to the channel. You can also follow me on Twitter at Mr. J. Thomason, where I post relatively frequently with different insight and charts and things like that. You can also check out my weekly newsletter that comes out every Sunday morning. The first half of it is free, absolutely free. The second half of it is for premium subscribers only. You can check that out. You can try a free 7-day trial and see all of the research that I've done, going back as far as you want to go. The 85th issue is going to come out this Sunday, so that's something you can go check out. And the links to both my Twitter and my Substack are in the description of the video below. So, what we've been looking at pretty much since the end of October has been just a tear to the upside. It was the strongest November across 60-40 portfolios in a really long time. It was like one of the best bond market rallies in history. It was an exceptionally strong month for stocks relative to historical standards. But since that decline, since the close on Friday, October 27th, we've had a gain in the S&P of over 11%. And the big question is, can this continue? So I want to try to look at things from both sides. We got to be non-biased here. We have to be open to moving and pivoting with the way that markets are going. And I'll talk a little bit about some other views that I've had that have now been proven wrong. And so we'll talk about that too, because I want to be transparent about those things. First of all, let's take a look here. S&P 500 here on the futures closing at 4,600, just barely over 4,600 on the settlement price. And what I find notable about that is if you go and you take a trend line and connect it from our January 2022 peak, and you go to one of our not the highest wick, but one of the higher wicks from the highs that we got to at the end of July and the very beginning of August, then what you find is that we actually on the S&P hit resistance cleanly, touched it intraday, and then kind of came off and closed below it. I'm not sure if that is going to be of consequence as far as a resistance level. I'm not sure if it's going to be strong. This is going to be our second test of it. So we'll see. I do want to call it out though. And by the way, just so you know, I look mostly at futures markets when it comes to asset classes and stuff like that. I have on TradingView, you can do this. I have the charts adjusted for contract switches and for settlement price. And so what you find is if you turn the adjustments off, then what you see is that we actually are a little bit higher in comparison. We're right around the same highs from the summer of this year, which are right around the highs from March of 2022. But it looks a little bit different on the chart, as you can see here, when you adjust it for settlement, when you adjust it for contract switches. But I just do that because I want the futures particularly to reflect actual accurate settlement prices. So just wanted to point that out, because I know that I've gotten some feedback before that some of the charts, some of my charts look a little bit different in their structure. But in any case, I mean, obviously, if you're looking at it from the non-adjusted, you know, situation, then the chart's going to look a little bit different. But the story, I mean, if you look at it that way, then you've got a breakout. Or if I go to be consistent from the same mark, then this is a breakout. It remains to be seen if it's important to do it that way or not. But that's just the way that I've looked at these charts. So I just wanted to call that out first. A couple of things to note. Last week we got a bullish tide cross. You can see with the green flag right there, which is obviously a bullish sign. Typically what happens in equities when you get a bullish tide cross or a bearish tide cross, you pretty much almost always get a retest relatively quickly after that cross. So like, for example, back in October we got the cross, and then when we came back up for the retest, obviously price pierced back through, so it ended up being a failed breakdown, a failed cross. So I'm looking for when this will come back, and I'm totally okay. There's plenty of markets out there you can trade, so I'm totally okay with having to wait on equities for this to come back to touch the tide line for its first test. But I do want to call out that bullish tide is usually obviously a positive sign forward looking for asset markets. So I want to call that out. If you look at it in terms of an RSI, the RSI on the, let me just see if I can put this up here. I didn't really plan to do the RSI, but if we just show the RSI, let me turn the moving average part off. Right now the RSI is at 72.21 on the S&P. If you look at it in terms of the SPY ETF, the RSI is like 74. It's pretty wild because, if you look at the Dow, the Dow's RSI is 79.68, and the Dow ETF is over 80. And the Dow, by the way, is at higher highs than it's had all of 2023. And the last time it was at this level was in April of 2022. It's kind of a big deal. But then when you look across the time series, every time the RSI has gotten up this high, it's had a pretty considerable pullback, over time. So that is something that we need to be aware of. But just sticking with S&P for now, what I would say is it's true that things can stay overbought far longer than longer than you expect. There's a lot of instances of like these market melt-ups happening. And also, just because RSI is over 70, which is typically the overbought level, doesn't mean that the price has to pull back super far. So like I can show you this example from 2021. We had the RSI pop above 70 here on Friday the 9th. And then as the RSI came down, I mean, it didn't until we had a steeper pullback later. It took multiple weeks for the price to come off below that level that it had originally crossed at, despite the fact that the RSI was coming back. So I do want to just remind everybody watching that just because the RSI is overbought doesn't mean that the price has to just come waterfalling down even as the RSI can come off. But what I will say is that the risk to reward of going long here, I know like a lot of people who are breakout traders are looking at this as a possible breakout or a pending breakout, and a lot of people want to take this, but the statistical probability of success when price is already at these overbought levels is really low. The risk to reward is not very good. And so I do want to just say that if you're not already in a trade, there's not really a good sense. I mean, it's Friday, so you can't anyway. But there's not a lot of sense in when futures markets on Sunday afternoon or the New York Stock Exchange on Monday morning when it opens up. There's not a lot of sense in just mashing the buy button here, just because the risk to reward favors more of a pullback of some sorts. That doesn't mean a pullback is going to happen. I mean, this could just go sideways, it could consolidate to the side while the RSI resets. So just because I'm saying the risk to reward on the long side is relatively small here, doesn't mean that means I'm saying that the price is just going to waterfall back. Now, speaking of equities and S&P, one of the things I want to call out is that over the last few days, we've been seeing some decent movement to the upside in the stocks above there. Oops, let me get rid of the RSI now. We don't need that anymore. Of the stocks trading above their 50-day moving average. As you have probably seen, this is something that I've looked at quite a bit in these videos. And what I want to call out for you specifically is that today we closed at 84.89 on this, and we're not far away. We're barely over 5 points away from the 90 level, which is typically an extreme, a bullish extreme, and typically a point where markets can reverse off of. And specifically at this level, I want to just point out that around this level, especially back in July, before we eventually did get the big pullback, the 10% correction, we had a little bit of a dip on this in mid-July before coming up to, we got all the way up to 89.26, so it didn't quite touch the 90 level. But this to me is evidence that even if price doesn't, maybe next week price doesn't totally come down, or maybe like price doesn't go straight up next week. But I would say that over the next week, what I will be watching very closely is to see if this can get up closer to the 90 line, because the closer you get to this, it supports the idea that the risk to reward on S&Ps are a lot lower or smaller. When you combine that with the fact that the RSI is so high, plus if I can pull up my data really quick from the AAII Investor Sentiment Survey, you see that the spread between bulls and bears is at the 91st percentile this week compared to 80% last week. You've got the bearish sentiment reading in the 10th percentile from 23% last week. If you look at it on a time series, you can see it here. We're up at levels that we last saw back right before the July, the end of July peak, and these are similar levels. Yeah. And then you can see earlier that we had higher levels than this on the bull bear spread during the period of time in 2020 and 2021, which of course was kind of a different scenario when the Fed was actually easing. And I would just say that like a lot of this exuberance today is because Powell spoke. Okay, we had a couple of pieces of data that are interesting we'll talk about. But first, Powell spoke today, and it was interesting because he reiterated that the Fed can and is willing to raise rates if need be, but also the market has kind of just like disregarded him, and some of the remarks led people to believe that he's essentially confirming that the Fed is done unless there are some crazy adverse developments. And those adverse developments, at least in terms of today's data and yesterday's data, didn't really materialize. So let me show you really quick some ISM data. Today we had the ISM manufacturing data come out, and you can see what I really want to draw your attention to is these kind of these black clear boxes, which are showing percentile rankings for a lot of these manufacturing pieces of data. And they're all really low, and all but two of them are at or below their 25th percentile, which is to say lower quartile, which is pretty extreme. And so one of the things that I would call out here that is important to note is that the economy is slowing, and so one of the things that people have read into is that the Fed doesn't really need to do a lot more work in terms of trying to tighten policy to slow the economy, because that is starting to happen. You're starting to see some labor market cooling with jobless claims, particularly the continuing jobless claims, continuing to rise after a little bit of a reprieve last week to the downside. So you've got that taking place. Then when you look at PCE prices, you can see the rates of change in the light blue bars are down versus versus the last month's rate of change time series. And real PCE and real goods PCE are below on a year-over-year basis and on a rate of change basis below their pre-COVID trends. And the real services PCE is almost right in line, both on a rate of change basis and on the year-over-year change. And then on an inflation basis, you can see that headline PCE and core PCE are continuing to decline on a rate of change basis as well, although really slowly. But we are really, really close to the Fed's inflation target as it relates to core PCE on a 3-month annualized basis. And so the market's taking all this economic data and saying, hey, all of the concerns, the growth concerns about the economy being too hot and inflation staying high and employment staying really tight, those are not persisting. But the economy is still relatively strong, not too strong, but relatively strong. So we've got this Goldilocks scenario taking place. And then, of course, you've got, the market is starting to price in rate cuts. It's actually pretty laughable. They're pricing in the probability of one single rate cut in March. And that's a whole thing that we could discuss, but I'm not going to take the time to do it today. But it is really interesting because the market is expecting that the Fed is going to cut, even though Powell reiterated that they're not even talking about cutting at any point, and they're not likely to. So it'll be interesting to see in a couple weeks when their SEP comes out for Q4, what they're projecting for next year as far as whether or not they're going to bring rates down, and that'll be interesting to note or to take note of. Okay, let's talk about volatility for a moment. Volatility is down. At the end of last week we closed, with a 12 handle, and even today we have a 12 handle. Volatility is even lower than it was at any point coming into, from 2020 to 2021. Even at the peak in 2021 and 2022, volatility still wasn't this low. You'd have to go back to before the COVID crash, where volatility was this low. And this is one of those things where I would say the odds of volatility moving further to the downside are possible, but it's not. It's weird to say. Like, you can go long periods of time with volatility at this level, but the odds of it going a lot lower, I don't think are super great. So we'll see if there's volatility expansion over the next week. That's something I'm going to be watching for. And then you've got the dollar, which was super oversold going into trading on Wednesday and ended up closing positive, and then booming up further on Thursday. Closed down today, closed towards its lows, but the question on my mind is if this dollar drop is ending and if we're going to establish a lower or a higher low here. This would be the opportunity to do it. If you've been on this channel a bunch, then you know that I talk a lot about these tide crosses, and you can't try to predict the cross right now. If price stays below the tide line, then it will cross over the next week or two, depending on price action. But if all price needs is a couple of good days to come up, and we can prevent that cross, and if the tide stays bullish, then that's not going to be a good recipe for asset markets. So I do want to call that out. Then I also want to talk a little bit about the yields here, because right now everyone's celebrating the movement on yields. We've got the 10-year coming in at 4.197, which is down substantially, over like about 80 basis points down from the peak that we hit in October. And a lot of people, let's just put it this way, a lot of people are calling yield top, just like they did during the long yield consolidations in 2021, just like they did in the summer of 2022 and in the fall of 2022. At each of those instances, people called top in yields and claimed that yields were going to be on their way down, and in no case were they correct. And everyone, and the problem here is that everyone is used to 40 years of bond yields largely headed to the downside. And I just don't know. I'm not willing, after the last couple of years, I'm not willing to say that, oh, bonds have peaked. I kind of have the same kind of feeling that I did at times throughout the pullback on the yield in early 2023, which is similar to how I was kind of seeing things in the end of the summer of 2022. In fact, if you go back on my Twitter, there's a tweet where on August 2nd, I was replying to somebody on Twitter about something, and I said, no, I think yields are going to go higher and make a higher high. And I felt like I was the only one who was saying that. And then go figure, the yields did go make a new high. And then somewhere around here in early 2023, I said I feel similarly as I did, back here. And obviously it did come down and go a little bit lower after that. But I mean, nobody, like right here, everyone's buying TLT and expecting that bonds are going to go up to the moon. And then we had the steepest, like unexpected sell-off in bonds where the yields went up. Nobody expected that. So the yield is still in bullish tide. So again, and I'm not willing to just go and say, oh, the yield has peaked. I want to look for a confirmation. It's going to take more than a tide cross, because we got a tide cross back in May of this year, and we still ended up going back to the upside. And as I've said before, when it comes to the tide, this is prime position usually for going long whatever the asset is. So, if I was showing you a chart of the equity markets and this is what it looked like, you would say, oh, this is a buy. And so the question is, are yields going to go higher from here, or are they on their way down? And I'm not really sure. I don't have a crystal ball. Nobody does. But with this has largely been, I think, in my opinion, the drop in yields has been the biggest catalyst for the booming in asset prices, because the Fed said, this has been talked about a lot, but the Fed talked about the rise in long-term yields being the mechanism for tightening on the economy. But if you go to the 30-year bond, the 30-year bond got as high as 5.18, and it's down 80 basis points lower, basically. So, that's a lot of loosening of financial conditions that has taken place. The same thing on the 20-year. 20-year got up to almost 5.38, and now it's down 80 basis points. So all of the major yields have dropped like 80 basis points. And in my opinion, is that the market getting ahead of itself? I mean, it wouldn't be the first time. It happened multiple times over the last few years. And so I just think that's something that we need to be cautious about as well. And then with the drop in the dollar and the drop in yields, I have been proven wrong on my thesis, which was that gold would not make a new all-time high in 2023, that would be a 2024 story. And with 17 or 18 trading days left in December in the rest of the year, today intraday we did get above the previous level. So the previous all-time high, to my recollection here, was at 2070. I don't know why actually that I have that resistance at 2075, but in any case, we did wick above that and have closed above that level. So gold has made a new all-time high, although again it closed below 2075, which I think is important. And honestly, I was surprised. I thought I shorted gold right here because I had a hard time imagining, just based on what I was looking at, that gold was going to reverse. And then today, when gold was touching the highs from the 29th, from Wednesday, I said, okay, if gold closes higher than here, then it's stopping me out. And so obviously it did. So that's too bad. But honestly, when you consider the fact that gold was, where was it? It was early April, right about there, gold above 2,000. when I made the call that gold was not going to make a new all-time high. If you had bought gold up here when everyone was getting excited about all-time highs, then you had to have ridden, a 20% decline. What is that? Is that 20% or is that more? You basically had to withstand, a 10% decline that just grinded and grinded and grinded and looked like it was going to get worse. In order to, you had to ride that out in order to even get to the point where you were breaking even, let alone in positive territory. And let's be frank, you also had to get a situation where an overpositioned market got a geopolitical crisis, which is what caused this initial rise. So a lot of things had to go exactly right for the gold bulls. And then on top of that, we've gotten the easing of financial conditions and the expectation of a pause in rate cuts. So that has really helped gold. And usually on the fringes of recession, right as the recession is kicking off, that's the growth slowdown and the pause of the rate hike cycle is the best time for gold, or not the pause, but the expectation of rate cuts. So so that's something, to me, I'm wondering why is gold appreciating still? And if gold is appreciating because the Fed is going to cut rates, well, why is the Fed going to cut rates? To me, the soft landing narrative isn't sufficient for this, because typically during periods of growth, gold declines. And how do I know that? Like, think about this. The Fed, gold spiked to its previous all-time high following the injection of liquidity and the cutting of rates to zero after the COVID crash. Well, gold peaked in August of 2020. They didn't start raising rates. They didn't start hinting about raising rates until October 2021, and they didn't actually start raising rates until March, and they didn't start quantitative tightening until June of 2022. So, you tell me why, despite the fact that the conditions were perfect for gold, why gold didn't go up. And part of it had to do with the beginning of the rise in yields that started to take place, which was related to inflation back then, and then has since been related a lot to growth. So, inflation is coming down, but it still is an issue. And if Goldilocks is the answer, then it doesn't make a whole lot of sense that gold is rising so substantially, despite the fact that the Fed is pausing and potentially going to be cutting at some point, if that's the market expectation. So that's my justification. And then when you think about too, like what crude oil is doing, crude oil is going to probably have a tide cross next week, unless price increases like $6 over the next week. And my question is, okay, if crude oil is declining, then what is that suggesting? Is that a growth slowdown? Because we've got this OPEC Plus talking about more production cuts, and the U.S. is already at full capacity. So it doesn't make a lot of sense that oil is going down unless what's actually being priced in is the growth slowdown, in which case, if growth is slowing down to the point where you're going to get a recession, then that's not what equities are doing. So that's a lot of that is kind of like long-term picture. I know I've kind of rambled a lot about that, but I'm going over that because in the near term, the markets honestly could probably continue to go up. I mean, I think at best we kind of drift a little bit, or maybe grind, maybe to the sideways, maybe a little bit higher. I think the more likely outcome, just based on sentiment, based on where the stocks and equity breadth is, where the RSIs are, I suspect we could get a little bit of a pullback. I wouldn't expect a super deep pullback, but in the near term, I do expect any pullbacks to get bought, and then price to eventually, over the next month or so, move closer to the upside, at least as things stand right now, because it's hard to imagine anything else standing in the way of unless maybe we get a surprise in the inflation data, or if we get a surprise rate hike from the Fed, which is not likely because right now the markets are 97% pricing no change for December, or if it's something in the S&P that's a surprise. I mean, outside of something like that, there's not really a lot of catalysts until you get into January and into mid to late January that would change things in such a way materially where stocks would see a prolonged downturn. So I suspect that maybe in the immediate near term next week or the week after, we might get a little bit of a dip, and then prices are probably going to move more to the upside, maybe even to all-time highs, which, in my newsletter a few months back was something that I was actually talking about, that prices would eventually get back up to all-time highs. So we'll see. We will see if that happens. So I think I'm going to leave it at that for today. Gone a little bit long today, but I missed last week, so hopefully you guys are all doing well. And so hope you guys have a good weekend. I'll see you guys next time.